Hello, everyone. Destiny is a little under the weather today, and we had some technical issues with GoToWebinar. Could have been user error on some of our parts since Destiny's not here. I'm not absolutely sure, but nonetheless, we have worked through that. We're super excited because we have one of our favorite guests, a regular, Jeff Smith. Jeff, how's it going today?
Oh, I couldn't be better. I couldn't be better. Thanks for asking, and thanks for inviting me to come back.
Absolutely. We always get so much great information. Your insights, incredibly valuable. So we look forward to hearing what you're thinking about the market today. Quick disclaimer for everybody. As you guys know, this is for informational purposes only. There's nothing that we're going to talk about today that is a recommendation for particular investments. And by attending, you acknowledge and agree that Catalyst and or its agents do not assume and hereby disclaim any liability to any party for loss or damage caused by the information contained in this webinar. And the same applies to Jeff Lifestyles Unlimited as well. So real quick, we're going to give Jeff a little bit of time to talk about the organization he's with as well as himself. But I've known Jeff for about 5 years now. He's a very accomplished investor. He's also extremely successful sales manager over at Lifestyles Unlimited, and has made a huge impact in so many people's lives in the real estate investment space. So I think we're very fortunate to have him today, and I'm sure he's got some great insights. So Jeff, tell us a little bit more about what you do over at LU and what you've done personally.
Sure. One point of clarification, I'm with Lifestyles Realty. Lifestyles Unlimited is the education piece of, it's really a separate entity, but I'm with Lifestyles Realty. I've been around Lifestyles starting out as a member for, my goodness, it's probably over 20 years. I would imagine, what year is this, 2022? So it's been almost 23 years. So
Wow.
Starting in October of 1999 is when I started to get the taste of maybe this is something I want to do. And by the next spring in early 2000, I'd started with my first 3 properties. 7 years later, after it took me 2 years or so to have enough passive income from my rental properties to not have to go back to my W-2 job. After about 5 years off, I started a family, and then when my daughter got to almost school age or preschool age, at the same time that happened, Lifestyles called and asked if I wanted to come teach classes. So I did that for a while, and then got a real estate license on a dare, and started working more closely with folks on their deals at Lifestyles as part of the realty brokerage.
Awesome. Well, that's a really cool story. And you've also own a pretty large single family portfolio of your own, isn't that right?
Yeah, we have scores of houses, and we've done a couple of small IRO multifamily deals and some passive multifamily investing as well. So we are, my wife and I are definitely believers. And we watched her father do the same thing. So we're second generation real estate investors and believers.
Absolutely. Well, we're going to dive a little bit more into the market update, cover a lot of what's going on nationally and also within the state of Texas. But if we can go to the next slide here, yeah, I see it. So I'm the founder and CEO. We started the companies back in 2012, so running on 10 years of these different companies. And Jeff Johnson has been with us since the day we opened Catalyst Funding, huge part of our growth. And Jeff has also had a very accomplished background in the mortgage industry since 2000. So we're going to have a lot of good experience and insight today.
So Jeff, I know you mentioned national, or Wade mentioned national earlier. So do you mind talking a little bit about the national movement? Because I know Lifestyles started out really just focusing on, they started in Houston and Texas, and they've started branching out quite a bit. Is that correct?
That is correct. Our Texas membership is not really the largest part of our membership now. We've expanded to a point where the number of Lifestyles members outside of Texas is, you know what, don't hold me to that. Yeah, I might be talking about Houston. I think it's Texas though, but the number of members outside of either Houston or Texas is approaching or just surpassed the number of Lifestyles members inside of, whether it's Houston or Texas. I'm not sure which, but the expansion has been fast. It's been the growth has really been impressive. Our Lifestyles Realty offices in yeah, most folks in Texas are aware that we're fully practicing in Houston, San Antonio, Dallas, Fort Worth, Austin, but our offices in Arizona, Georgia, Tennessee are really growing fast, and we have more to come.
That's awesome.
In the next few weeks, actually. So,
ooh, a little scoop or what?
yeah, I'm not allowed to say where yet, but we're growing. We're growing,
right.
and if you can figure out my sister's address, then you can figure out where that.
All right.
Have to do some sleuthy detective work.
It's challenge accepted, right?
Jeff, do you want to go over our value proposition?
Sure.
We'll dive into it.
So for those of you that maybe haven't worked with us or are just kind of coming here for the first time. So Catalyst, we are a lender built for real estate investors. We like to think of ourselves as a one-stop shop for all of your investing needs. So we take folks that have never done a deal before. Maybe they come to Jeff's organization and they go from start to finish. They get their first deal, they do a hard money loan, they fix it up, and then they refinance it into either a long-term conventional or non-conventional loan. We are built by real estate investors. So Wade didn't mention it, but before we started Catalyst, we did real estate investing ourselves, flipped homes, wholesaled homes, have the term, I never use this term, but has a score of rental properties like Jeff. So we as an organization, we are fully aware of the buy and hold model and folks that want to build a big rental portfolio. All of our loan officers that you would ever interact with are licensed. So you'd have a single point of contact. They can take you all the way across from hard money through to conventional. And eventually non-conventional. If you get so many properties, you need to pivot. We're going to average 5-star customer experience. We're very proud of that. If you look at all major channels, we average 5 stars. Like it says, we do hard money, conventional, and non-conventional. 30-year fixed, no income doc loans. So for those of you that are maybe a little unfamiliar, we have non-conventional or no income doc loans, where you can get a long-term loan for a 30-year fixed rate, and you don't have to prove any kind of income. We do a lot of primary refis, purchase, and cash outs. Not so many refis, but a lot more cash outs, and we'll talk about it later in the presentation. Their rates have gone up a little bit, obviously, but their equity has gone up even more. So a ton of folks are tapping into that equity to pull cash out to do more deals, whether it be flips or with more organizations like Jeff. Hard money loans, we do flips as well. We have a VIP flipper program for folks that are very experienced, well capitalized. We try and give them great service and rates, etc. And then non-QM loans with a FICO as low as 500.
Actually, Jeff, that was recently changed. I think
as I said it, I was like, wait, I don't think that's right anymore. That did change.
Yeah, we're up to still down to 620, which is pretty amazing for someone who does not have to prove their income, but that is a shift that just recently happened, and we need to get this updated. So,
yep. Next slide, please.
So this is a very interesting chart. You guys know where rates have been. If you look in this chart, the increase in interest rates there on the far right side has been rapid. And it's really been an incredible time. Several time frames broke all-time records for rate increases over such a short period. So the good news is that real estate investments can still be an excellent avenue. I mean, it's really a matter of maybe adjusting your offer prices some, and we've seen the market adjust to the higher interest rates, but there are investors still doing a ton of deals. I mean, for our business personally, we had a a little bit of a lull for a moment there where investors were seeing where interest rates were, but I think we may break a all-time record on the hard money side this month. So I think investors are really getting their sea legs under them, feeling very comfortable about where rates are going, and are able to come up with great cash flow, great ROI, despite those modifications. And, you know, another interesting thing, whenever you look at the rates and where they are, you know, if you have a very short memory, then it looks like they're a lot higher. But if you go back to pre-2010, rates have still never been as low as they really are today for any extended period of time. So, and people were doing real estate investments and making a mint back in, you know, 70s, 80s, 90s, like through all time. There is an appropriate price at which you can buy and make real estate a great investment. Jeff, anything to add to that on that slide?
Yeah, definitely. So there are a couple of things on this interest rate slide. I mentioned earlier I bought my first property in early 2000. If you go back and look at that I mean, I think these are for owner occupants, right?
Yes, they are.
So as an investor and as a first-time investor in spring of 2000, I paid 9.9% on my first property. And I thought I was getting a steal on my second property at 8 7/8. And so none of this 6%-ish interest rate scares me. I think everybody sets their expectations at their start, right? And so since it's still, you know, a third lower than where I started, to me, it still looks like money's on sale. It's super cheap to borrow money, especially when you consider what we're making with the money that we're borrowing. And back when I started in, you know, 20 something years ago, I was my own property sourcing person, right? Now I've got this whole team at Lifestyles Realty. And when I got my license, I started winning top producer awards from the Houston Association of Realtors. And our team today is way better than I ever was. And so I'm super excited about what's coming. Everything you're going to hear from me is optimism. I'm just thrilled with any kind of change, and there are ways to make any kind of change in this marketplace to your benefit.
Absolutely. So here's the biggest question: the property you bought at 9.99% interest rate, do you have any regrets that you bought it since you paid 9.99?
No. You know, I still own that one. Of all the properties I've bought and sold, I still own the first one I ever bought. Yeah. And so I think I paid $29,000 for that property, and it would probably sell today in, I don't know, 180. Wow. 180, yeah. And I've made cash flow the whole time. So no, I have no regrets at all.
I didn't. It was kind of a rhetorical question, but I figured your answer would be a resounding yes.
Yeah,
I will tell you this: if you look at this chart, right, you have all those gray areas. Those gray areas are recessions, and we just had 2 negative quarters of GDP. You would think there'd be a gray area here that would signal another interest rate drop, right? But there's no gray area there. So
we're not in a recession, Jeff.
There are a lot of questions about that whole thing, but there's not one here for me, right? That 9.9% interest rate loan only lasted 3 to 5 years before I refinanced that thing.
Right.
Down to, I don't know, 6 at the time, whatever it was in, 2004, 2005.
Yeah.
And so, and also by that same time, the properties in that neighborhood weren't $29,000 anymore. So I did way better by buying that property at a higher interest rate than had I waited for the interest rate to drop and then bought it.
Absolutely.
Yeah.
And you got to take money out whenever you refied it, and that's tax-free, right? However much money you got, you can throw it into other investments, tax-free. Like, that's the great thing about real estate. Well, one of the many great things about real estate are the tax advantages too.
Sure.
All right, let's go to this next slide. Just to give everybody, we haven't always had this slide, but the blue line here is the new housing starts, 1 to 4 housing starts, single family 1 to 4. And then the gray line is the population. So as you can see, the last time that we were building this many homes, let's just go back to, we were building
2000.
2000-ish, right? And the population back then was maybe I don't know, between 290 and 300 million. Now we're close to 335, and we're still not, significantly greater population, still not as many housing starts. Now we've really ratcheted up, but I have seen, and I think we may cover some data today, where the housing starts have actually slowed a bit. But one category that hasn't, I think, is an all-time record for apartment starts. So a lot of the new construction in single family is for people to be in buyers. That has slowed a bit, but there is no slowdown whatsoever in anybody that's thinking about renting the properties out. That area is still in a massive growth stage right now. Anything to add to that, gentlemen?
I would say this, if you starting in 09, these last 10, 15 years, this is a big reason why we're in the shortage that we're in right now. It's just because as population was growing, we just weren't building any new homes relative to the size of the country. So, I mean, they're trying to catch up, obviously, but this massive shortage in new home builds is a big part of why prices have gone up.
So when I look at this, when I look at new home construction, right, how that's going to affect my business in being a housing provider, there are a few things I look at, right, because this is new supply coming onto the market, and is that going to be supply that competes with me? And so when you can get this information with a different look from the National Association of Home Builders, and the way they present it is housing starts per million of population, and it goes all the way back to the 60s. And we were in the 60s, 60s and 70s, we were right around 50,000 housing starts per million in population. And then by the 2010s, we were at 21,000 housing starts. I mean, less than half. Right? So we have a lot of catching up to do. Even if it stayed at this level, which on this chart, which I did a little bit of the math here a minute ago, that's 5,300-ish housing starts per million this year. So if the National Association of Home Builders presents it by decade. So even if it stayed at that level for a decade, you're still at the 1970s level, and it's just not enough. There's just not enough of it. So, and then when I look at what they're building and where they have to be profitable, the same place at the National Association of Home Builders, every 5 years, they put out a study about, all right, how much of the cost of a new home is in regulation? And the last time they did that was 2021, $94,000. Can you spend $94,000 on regulation and then build a home that can be profitably sold at a price where the median income family can afford? No, you're building much more expensive homes with costs that high. And that's before you've paid for labor, which there's an extreme labor shortage. That's before you've paid for materials. And if you look at the producer's price index for residential construction inputs, it's up 40% since 2020. So you're overpaying for labor, you're overpaying for material. And where do you think the price of ready to build lots has gone? I mean,
awesome. Way up.
All of these costs for these builders are way up. So even if they can sustain this level of production that you have here, they can't build what we already own. They can't build what we're buying. And so I would encourage anyone considering getting into the housing provider and investing in rental real estate, get as much of this as you can as fast as you can.
Completely agree.
All right. So this is an article that we found in Fortune. It says home prices to fall in these 123 housing markets, while 780 will go higher. So obviously a mixed bag, but I don't know what the math, that is probably close to what, 80% are in the positive, right? So Zillow economists predict 123 regional housing markets will see falling home prices. The chances of a nationwide home price correction in August are low, given the fact that inventory levels are 44% below pre-pandemic levels, kind of like we were just talking about. CoreLogic, Fannie Mae, Freddie Mac, and Zillow are all forecasting positive home growth. I did see one of them drop their guidance, but it was still positive. And then meanwhile, firms like John Burns, Zonda, and Zillman are predicting falling home prices. Robert Schiller predicted the last housing bubble and thinks prices could fall 10%. So, I mean, and we have a slide on the next one that kind of shows the locations, but I kind of see this as it's very localized as to which markets are going to do well, which ones are going to suffer, which ones are going to kind of punt and just kind of stay the same. It is very regionalized, in my opinion, and you can't look at the national numbers and gain much from it. It's more of a local deal.
Yeah, the founder of Lifestyles Unlimited, he says, he's a saying, it goes like, heads I win, tails you lose, no matter what I win, right? And he's usually talking about that in the context of arranging your lease to cover you no matter what the tenant does, right? It's more in the property management context, but sometimes that applies to this as well. No matter what the market's doing, right? If you've got rising home prices, there's two sides to that: supply and demand. Either because you don't have enough properties, or you have a ton more buyers than you used to, right? And so that's just driving up the supply and demand curve. Prices go up. If that's happening, right, more people are on the buyer side of the equation. More people are looking to buy. They're raising the values of our properties. So in an upward trending market, real estate investors our balance sheets are growing. Our net worth is expanding like crazy. When you get to the next slide, if any of those properties are where we operate, it's good news. Why is that? Well, then the buyer pool shrinks and the tenant pool grows. And instead of our balance sheets growing, it's our income statements that grow. Our income grows, rents rise in that scenario. So, you look at this and, housing prices up, housing prices down. That's just a gauge to me of, all right, how much is my net worth going to go up, or how much is my income going to go up? Good news either way. Heads I win, tails you lose. I win no matter what.
Yeah, if you're in the game, you're winning it for the most part, right? And I do want to echo what Jeff said about it being very geographic. And I think Lifestyles does a great job of helping people invest where they want to invest and live where they want to live. I mean, every time we're at these Lifestyles Unlimited events, there's an enormity of people from California, New York, Illinois, places where people don't really want to invest for a wide variety of reasons, but really investing in the places where you can be very profitable. And if you look at the areas where Lifestyles is typically having people invest, we can go to the next slide. Can we see that? Thank you very much. So, Lifestyles has offices in areas that are all either dark blue or blue, right? You got Georgia, you got Tennessee, you got Texas, Arizona, like all very, very dark blue areas. And they select these offices for a wide variety of reasons, but I'm sure one of the biggest ones is the potential for real estate, not just in going up in value, but being excellent areas to be a landlord, to be holding property. So that really, even though there could be some down markets, it's not really in any of the areas that Lifestyles Unlimited is really encouraging people to invest.
Can I guess where your sister lives based on this map, Jeff?
Sure. Give it a shot.
I'm gonna guess she lives in Florida, but we'll see.
Yeah. No, but
Florida? All right.
I might be buying in Florida soon.
All right.
Yeah. Lot of dark blue in Florida, right?
That's true. Yeah.
Whole state.
All right. So, and we hear these questions a lot. We get asked these questions by borrowers. So some of the reasons we're covering it, we saw some national statistics, some people prognosticating that values may go down in certain areas or maybe even across the country. And there's another question that we've heard a little bit, like, should I wait for the real estate market to crash before I buy a house? And we've talked about this for some time. Jeff and I have been in the Jeff Johnson and I have been in the lending industry. We went through that crisis back in, the great financial crisis back in 07, 08, 09. And then, Jeff was certainly a part of real estate investing in that time, whenever people really had enormous upside from that. But there's a couple of different reasons why most people do not see a crash that are really in the know. Number one, the credit standards were very lax back then. I mean, it was not only were there a lot of alternative products like interest-only products that were used with great regularity, tremendous amount of adjustable rate mortgages. The number of adjustable rate mortgages today versus how many were adjustables back then, just a fraction. And then also the FICO scores were significantly lower. The median score right now of newly originated mortgages is 773. That's a very, very high number. It was not anywhere near that because, we were making so many loans with people with 560 and 580 FICO scores back then on questionable loan products that the scores were really driven down. And then 65% of new mortgage holders had a score of 760 or more. So very strong credit quality. The next topic here is that homeowners are doing just fine. They're paying their mortgages. There is a bit of a credit crunch out there in like consumer debt that we do need to keep an eye on. I do want to acknowledge that, but as far, people are going to pay their home before they pay their credit cards, and people are doing very well in this particular category, and they have a lot of equity. That's the other thing that's very different than 08. It's tough to go out and find an easy solution whenever you don't have any equity in your home and you're upside down. But whenever you have equity in your home, the solutions are many. You can get a cash out loan to pay off some things if you're struggling a little bit, or to make repairs that are necessary. Very different situation than last time. And then Dave Ramsey, who, while I don't necessarily agree with his philosophy, and I know Jeff Smith doesn't either because we both have a lot of debt in real estate, the guy, he does understand some things about the market. And he talks about how there's just a tremendous oversupply in foreclosures back then, and that it was truly a real estate incident that caused like the economy to struggle. Right now, the economy's struggling, and it may trickle into real estate a little bit, but it's the type of event is completely different. Jeff Smith, anything to add to that?
Yeah, I think so. I don't hate Dave Ramsey by any stretch. I took his program, just, I think it's a 13-week program or something like that. It was interesting, but you're right. The part on leverage and investment real estate is not a practice for me. Now, I will say this, that the Mortgage Bankers Association has an illustration of all of this in one chart. It's called the Mortgage Credit Availability Index. The Mortgage Bankers Association updates this thing every month. And to give you an idea, it basically measures the availability or supply of mortgage credit in the marketplace. And so they picked March of 2012 as, all right, here's our standard. This is our standard by which we're measuring it. And they gave March 2012 a score of 100 on this index. Now, anything above 100 is considered to be loosening standards of credit. It's easier to get a loan. And so you're talking here about, prior to 2008, things got really, really loose. And if it drops below, then it's tougher for your normal everyday home buyer to get a loan. So it started, so they're 100 in March of 2012. The highest it's gotten to since they set that standard is 190, right? So it got, theoretically, it got a lot easier to get a mortgage, and that was back in like 2019. And then in 2020, everything froze, and there was a mortgage availability crash, and it dropped to like 120. And then when rates started to rise this last month, it dropped to 108, right? So we're at 108 compared to 2012. We were buying the crap out of properties in 2012. And so if we still have the same mortgage credit availability as we did then, they're, all, full speed ahead for me. Now what's interesting is that they also point out what it was in 2006, right? Prior to the crash,
How big
right?
was that number?
900, almost
I was gonna
900,
say,
right?
yeah.
And so when you put that on a line graph, it is stark. How different the environment is today compared to then. And the people who have borrowed money for their homes in the last 10, 12 years are in nowhere near the shape that they were prior to the crash in 2008. So this backlog of foreclosures that you hear in some circles, I just don't believe it.
Well, I mean, if you look at the bullet point, what number? I guess 2.1 right there. The share of mortgage balances 90-day past due is 0.5, a historic low. So like nobody's past due right now. And I get that could change, but to your point, if they've been running in that credit tightness level of the hundreds relative to 2012, and it was in the 900s that kind of got us into this mess, I don't see that playing out the way it did back then at all.
No, not even close. Even the people who went into forbearance agreements in when things shut down 2 years ago, the National Association of Realtors put some information out about that, and most of those people have resolved that, right? They've either modified their mortgage and put what they missed on the back end of it, and now they're trucking along as usual, or they paid it back, or they caught up, or they sold, or whatever they had equity, so they could sell to get out of that dilemma too. So if there is a wave of sellers on the way, it's not them.
Yeah, that's the thing, is I just don't see where, this massive oversupply really comes from. There's just too few houses now. People have taken a little bit of a pause. Don't get me wrong. People are having to buy a little bit less of a house than they were before. That's just the stark reality of it. But it's still people. There's a lot of people that want to buy houses, and millennials are getting into the age bracket where they want to move out of their parents' home. They don't want to stay in it forever. And quite frankly, I'm sure their parents don't want them to stay in there forever either. So there's a lot of new buyers, and the math just doesn't add up, to your point.
I don't know. My daughter just went to college at 18, and I'm thinking right now 18 wasn't long enough, that she should still be here. But I wonder how my mom felt with my brother at 25.
I'll say, yeah, come talk to me if she's still there like 8 years from now.
It's a big difference. It's a big difference. All right, let's look at this next slide. There's obviously it's an interesting market right now with interest rates being where there's usually a significant amount of discount points being charged, and that's because there is some uncertainty in the market. And on conforming loans, as an example, there is no prepayment penalty on those transactions, so investors and lenders are wanting to get some points up front. But if you look here historically, if you want to stave off inflation, we have a long track record. The way you do it is you put rates above inflation. That's still not something we've done to this day. We're quite frankly not even close. But that's an interesting situation. Now, in some of these other times, we also didn't have a recession at the same time, which complicates things a little bit. Although there was certainly financial duress in the late 70s, but that's an interesting thing to see, that this is the first time it's ever, the rates have been this far below the inflation rate, and what that's going to mean.
So the powers that be have a decision to make, right? Right now they're deciding, they're trying to decide, do we fight inflation or do we fight recession with the tools that they've always used? And the strategy is opposite for each one of those, to fight each one of those opponents. And so they really just have to pick one, right? If they're going to fight inflation, rates are going to continue to tick up. They don't recognize that there's a recession, apparently. So looks like they're going to continue to fight inflation. But if they change course and decide to fight a recession, then they're going to lower rates, and you got to pick one.
Yeah.
You can't do both at the same time with the same tool.
I think, and we had these questions asked as well. Do I need to time the market? Do I need to time interest rates? I think to your point earlier, Jeff, the thing is to get into the market because you're going to win either way. And, just stealing some terminology from stock market investors, dollar cost averaging, that just means that you're consistently investing because you can't really time the market perfectly. Same thing for real estate investing. I mean, the thing is staying active, buying properties. You're never going to time things perfectly, and you're either going to have regret or excitement from either one of those two things if you wait around. More often than not, it's regret because you just didn't get into the game and start to get that appreciation and cash flow.
I mean, think of it this way: if you buy deals now and rates go up, well, then you're smart, right? You bought it and you get a good deal, better than the competitors. If you buy it now and they start going down, wait a little bit till it makes sense and just refinance. Like, it's not complicated, but what is consistent is the value of the real estate. With very few variations here and there over a long time horizon, the value of those properties goes up significantly.
Oh, yeah, if you get a chance to do this exercise, I recommend it. Just get a map, a poster map of the HAR MLS area map, right? That has all of the market areas in the Houston Association of Realtors, and then throw darts at it. Try to hit the part of town you want to invest in, and look and see what was the median price of a single family home in that part of town in 2007, right? If we have a crash in 2008, then 2007 represents a peak. And then look and see what the value is 5 years later or 10 years later. And I don't think you would be disappointed in your investment, even if you couldn't hit your favorite part of town with your dart. You're still going to be happy with your investment.
Yeah,
100%. Jeff, tell us about Houston on the next slide.
The next slide. All right, so I'll cover these data points, and then since this is your home base, Jeff, I'd love to get your insight of what you think. But so single family home fell 17%, the total property sales. Days on market dropped to from 26, excuse me. Total property sales were down 17% of 10,000 units. The total volume was down roughly 10%. Single family median price went up to, I don't think it's $3.3 million. I think that's a typo. So 348, 740. And then the average price went up 10% year over year to 426. I don't think that's the highest it's ever been. It looks like 438 was the highest. But year over year, it's still up 10%. So if I look at that chart, we've been talking about for over a year now, eventually the volume, or I'm sorry, the units are going to slow down just because there aren't enough properties available. But we've also been talking about how the prices have been going up because of that very, very same issue, right? And the inventory is going up too, right? It was 1.7 last year. It's up to 2.5 now. 6 is a market imbalance, so we're still well below 6, but it is higher, right? So they're slowing down a little bit. Jeff, anything to make of these numbers?
Yeah, again, like I mentioned earlier, I'm going to be optimistic because I am optimistic about everything that I'm seeing here. And so you mentioned the months of inventory. If you can only monitor, if you're busy, if you can only monitor one metric, that's the one to monitor, right? Because it takes data from both the supply side of the curve and the demand side of the curve. Now, you mentioned 6 months of inventory is a balanced market, and we haven't seen that in a long time, probably 10 years. And so a balanced market would be where properties exposed to the market long enough get their sales price or close to it. At 6.5 and up, you might start seeing price reductions, right? So inventory is growing. how are prices up 12.7% or 10% based on whichever one of those two metrics you like better? It's because we're only at 2.5 months of inventory. And now what I'm going to watch very closely is that months of inventory metric, but in September, right? When all of the people who are trying to buy properties before school starts, when that's all out of the system and they're closed in August, what does that months of inventory look like in September and October? I think that's going to be telling, how much does that move? And, those September and October, I think, will define for me what to expect for the next 6 to 8 months.
That's a very good point. Where the inventory is going into what's traditionally a little bit slower season. We haven't seen much of a dip in the winter months the last few years, but that is much more traditional.
Yep.
Another key thing to look at for everyone, if we could just wrap up on one thing. February 2020, right before the pandemic, single family rents were $1,768. So let's just imagine you went in there, you're a little bit nervous. You bought a property and your cash flow, and let's say you're cash flowing $300 a month then. Fast forward to now, where single family rents are up $400. So you're cash flowing $300 back then. Very short time frame, cash flowing $700. And that's the power of real estate. When all these things go up, you still pay the same amount for the house at the same interest rate. Your taxes could go up, maybe insurance a little bit, but for the most part, your cash flow has just really skyrocketed in these past few years. So once again, timing is not the most important thing as it is just really making sure that you're in the game. Because even if you bought it at that point, you're in fantastic shape overall at a peak.
Next slide.
All right, this San Antonio. San Antonio, I know lifestyles, a lot of the lifestyles people believe this as I do, that San Antonio is right up there with Houston, just an excellent rental market to get into, still very reasonable price points, a little bit more reasonable on the price point than Houston is. Rents are a little bit lower on average, but just an excellent market to get into. You see the home price appreciation up 12% year over year, median price up 15%. And then a very interesting number there is how much the price per square foot has gone over in that same time frame, up 35%. That's an amazing number, right? So if you're a person out there where you're looking to sell that property and you didn't have to build anything bigger, it's just worth a hell of a lot more because of that price per square foot increase. And then the residential rent rates are steadily increasing as well, 11%. Average price increase year over year, and the price per square foot rental increase is up about 9%. Days on market also up a little bit on the rentals. So overall, still a very, very hot market for real estate investors, especially buy and hold investors.
Oh, I'm high on San Antonio. I may have mentioned this. I don't know if I mentioned it on here or to you guys in the office, but my daughter just moved to San Antonio last week, and that's where she's going to college. And so our plan, she picked her school based on what cities I was willing to partner with her on real estate investing. San Antonio won. It was far enough away from me, and also a city I would invest in with her. And so, so she moved there last week. So I joined the board of realtors there and just started looking through their MLS to get a feel for the marketplace there. And within 15 minutes, I found 3 properties that had $50,000 or better equity capture right out of the gates. So imagine if I do that and go invest with her there, and we can buy 3 or 4 a semester or in a school year, right? By the time she graduates, she has 10 or 12 properties, and she doesn't get all of it, right? I'm her partner. She's got to split that with me. But imagine being fresh out of college, graduating with 10 or 12 rental properties, and I don't know, what does that comes to $250,000 worth of equity and 30, 40 grand a year in income before you ever have to even apply for a job. Do you think she's ever going to work for anybody but her?
Hmm. Yeah, that's a
No,
that's a
I'm high on San Antonio, very high on
yeah,
San Antonio.
it's a great market. You know, another cool thing about real estate investing that I'm just gonna slip this into the conversation. I'm sure I don't know if you took advantage of it, Jeff, but I know a lot of people do. Is having your children work for you to help take care of your rentals and paying them a wage, and for you, it's a tax deduction, and oftentimes for the children, they don't pay taxes on it, so it's a total win-win. You can pay for things that are, candidly, things you were going to pay for anyway, right?
Right.
It could be so many different things. It could be a tutoring, it could be basketball lessons, or it could be flute lessons, or whatever it might be. And you can do that through a vehicle where it really changes your tax situation. That's another huge advantage on real estate.
Yep. No, Gracie is QuickBooks certified. She could do our uh, do some of our books.
Yeah.
My son is definitely capable of destroying anything and handling demolition of anything.
Everybody has a skill set, right?
Right.
All right. Well, let's check out Dallas. You want to tell us about Dallas there, Jeff?
Yeah. So our office in Dallas. Well, I mentioned our San Antonio office is growing ridiculously fast. Our Dallas office is growing as well, and I'm seeing a lot more properties come get blasted to our membership from our Dallas agents than I ever have. So while I'm not personally not buying in Dallas, I'm gonna continue buying in the Houston area and San Antonio and possibly on the East Coast. Dallas looks really strong to me. Dallas, really strong employment almost all the time. I mean, it's just such a centrally located area, and it's bigger than we are here in Houston when you combine the entire metropolitan area.
It's a very diverse economy. You know, we are not where we were in the 80s, being as dependent on oil and gas. We're much more diversified. We still have a heavy oil and gas industry here, whereas Dallas is really a financial center, incredibly diverse, right? So many corporate headquarters and many more moving in by the day because of the great tax structure in such a business-friendly state. So I think they're just going to continue to go up. Although I will agree with you, in that area, oftentimes it's more of an appreciation play that's going to be consistent. The cash flows, you can struggle unless you're sometimes getting on the outskirts of Dallas, or maybe looking at 2 to 4 units, or maybe even some small multifamily.
Look, I don't mind the outskirts. I've got property on the outskirts of
Sure,
Houston.
me too.
I'm from the Washington D.C. area, and a lot of my family who works in the D.C. area commuted 2 hours one way. Right, the West Virginia suburbs were considered commutable. Right, imagine driving 2 hours one way, and Dallas seems to have similar characteristics. And so people are willing to do that, then you're gonna have strong rental demand.
You know, the great thing about buying in the outskirts is sooner or later it's no longer the outskirts.
That's
Like,
true.
so many of these properties that were, way out there in the past, now, you build a new beltway or whatever, the Grand Parkway, and then all of a sudden it's just property prices are going through the roof.
Yeah.
Yeah. Just real quick on that, I noticed, because that's a North Texas report. I noticed how similar North Texas is to Houston. If you include the area, right? Not just Dallas, the city, that's a little more pricey. So if you include the area, it's basically like the Houston market almost.
Yep.
So Austin, so this is obviously the outlier in our great state. Median sales prices of $500,000. Days on market up 10 days. So that's significant when it's almost 50%. You guys doing a lot of deals in Austin? Like Wade said, is it more multifamily type stuff if you are doing them?
Generally, Austin for us is a multifamily area. Now there are, in between Austin and San Antonio, and again, outskirts, right? We're doing some single family business, and we have an agent that really focuses on that area. But no, it's not like a super high volume area for single family investing for us.
Yeah. Speaking of, so I saw something that, I don't know where I got it from, so don't hold me to this, but the county that's just north of San Antonio that goes up to like Canyon Lake was one of the fastest growing counties in the country. Does that sound right to you guys?
I've heard that too. I mean, that area is just incredibly hot.
Like New Braunfels and Canyon Lake, that little spot right there.
Yeah. And you know, so many of these numbers looking down, they're off, like in Austin, they're off absurdly high numbers, you know, incredibly low months of inventory that were just not sustainable. Like, just so whenever you look at these numbers, you have to take it with a grain of salt. It's off from the best they ever were and probably ever will be, because of some very unusual situations, but still these numbers are fantastic relative to, you know, any other time of measurement.
I will say it's weird to see Austin with a higher months of inventory than Houston.
It is.
If you had told me that a year ago, I'd have said you're crazy. Like, no way. But
Yeah, they were measuring in weeks, right? I mean, days maybe.
Yeah.
If, you know.
Oh no, for real. Look, I mean, it's up 1.8 months. So if you just look back that this time last year, they were less than a month.
Yep. So this is always one of the charts that gets us most excited, you know, Texas real estate investors, whenever it gives a little bit of context to what we think. Wow, you know, Texas may be getting more expensive, but it's really interesting. Austin has downticked a little bit from a few months back. I think they got as high as like 18, 17 on this affordability index, which should be called the unaffordability index. I guess the higher you are, the worse it is. But and then Dallas actually downticked quite a bit, because Houston and Dallas were both up close to 20, like maybe 21, 22, something like that, right behind Austin a few months back. So really, and what that's telling us is home prices here aren't going down, but in other parts of the country, they're still getting a little bit less affordable, especially with the interest rate changes, right? Because as interest rates go up, there's a big impact, because housing becomes a more significant part of your overall budget. And so really, this is super encouraging to me, because you have cities like Dallas and Houston and San Antonio, which is way down at 53, that had the amenities of these cities that are ranked in the top 5, 6, 7, 8, right? Same amenities, you know, amazing economies, strong job markets, you know, entertainment, just great cities overall, but exponentially more affordable. So as we go forward, I think that's a big thing that's been a trend. Constantly people moving into these markets, which Lifestyles Unlimited is supporting in Texas and also Georgia and then Tennessee. And I just don't see that trend changing, because of the excellent markets that they are, and people need to get out of these areas that are far less affordable.
They do. They do. Now, you know, one of the things that affordability piece tells me is, all right, what's coming down you know, that's a spot in the marketplace where you would think somebody would recognize there's opportunity and fill it. And then you sit there and you think, well, who's going to do that, right? We talked earlier about the builders not being able to do it. It's us. Mm-hmm. That's where we play, and it's our job to fill that need, because the builders can't do it. Right. And you know what happens when government, you know, builds housing projects? That doesn't work. So it's us. We've got to fill that void.
Yep.
So this next slide, Jeff, I know this is your baby to a certain extent, so I'll cover real quick what we're looking at. But sure. Cash out refis are just an excellent thing to do right now, irregardless of rates. So Jeff and our team, primarily Jeff, help from Devlin, our operations manager, and some other people, we wanted to provide a visual representation to investors on how not getting overly fixated on the fact that you may increase your interest rate to do a cash out loan to fuel your real estate investments, and how that is an excellent move. It's just bottom line math, but you can't get too caught up in the interest rate. That's something people like to brag about at dinner parties, that, you know, I got this low rate, whatever the case may be. What's a lot more enjoyable to brag about at a dinner party is how you just increase your cash flow by $2,000 because you bought 4 single-family properties or something like that. I think that's a better thing to say. But this is a great representation of that. So Jeff, take it away on this report.
Sure. So I don't know, something just happened. Can you guys see me? Because I can't see anybody now.
We can't see you, but we still see the presentation. So that's good.
There we go. All right, we're back. So yeah, so like Wade said, this is basically, it's a comparison of it's a typical homeowner. They're in a situation where they own a home or homes, rental or primary, doesn't matter, but they own a home. Maybe they're sitting on a great interest rate and they're very reluctant to do so. And so it's just math on scenario number one is you don't do anything, you keep your home, you keep your rate, and where does that play out? Or you use the equity that almost everybody has built up over the last 5-10 years, and you pull cash out of that property and you deploy that cash into other projects and other properties. So this first slide is, and I'll just go through the numbers. There's some assumptions on here. So we looked at the average appreciation rate is typically about 5% per year. I picked a very short time horizon, 10 years. Most of the, I know a lot of the, Jeff, I know a lot of the LU guys, they have short time horizons. And I just wanted to be fair about it, because if we were to go to 30 years, it gets obnoxious. Plus, you never know how old somebody is, right? They may not really care about 30 years down the road, but 10 years down the road now. So this is a very conservative time horizon, 10 years. So typical scenario, your house is worth 400, you owe 150, your mortgage payment's 840, you got a 3%, you got a great rate, you got a 30-year loan, you paid it down, you borrowed 200, you're down to 150, and you have 19 years left on your mortgage. So the value of the home at the time horizon, assuming that 5%, is going to be 650. 10 years down the road, you're going to owe about 80 grand. So your net worth, if you do nothing, is going to be about $570,000. Plain and simple. You got a $400,000 house. 10 years down the road, it's going to be worth 650. You're going to owe less. Your net worth is 570. Sounds great. So if you go to the next slide, thank you. So if you go to the next slide, what we're going to do is make some assumptions. I don't know if somebody changed that. I can't see.
Yeah, that doesn't have any numbers on it. I'm not sure why. The one that was
no, it does. There you go. Okay. There we go. So you're refinancing. You're going to do 80% refi. Now your rate's going to go up to 5.5, right? You're going to do a 30-year loan, and your new payment is $1,817. So your overall payment is going up $970. You're thinking, oh, well, that's a bad deal. But you're also pulling out over 150 grand cash. So Jeff, I don't know what you guys are seeing. You can change this if you'd like, but you're averaging about 30 grand out of pocket for buying new investment properties. So with that 150 grand, 30 grand out of pocket, you'll be able to deploy that money and buy 5.25 houses. So let's just round off. You say you're going to buy 5 houses with that money, and you're going to average about $250 a month in cash flow once you get them all fixed and leased. So in the beginning, as soon as you get these properties leased out, you're making $1,300 a month on your 5 new properties cash flow. Remember, your payment went up $970. So as soon as you get these properties bought and rehabbed, you're already plus $330 on your monthly cash flow relative to what you're at before. Now, like Wade said earlier, your payment's going to stay the same. Taxes and insurance may go up slightly, but rents are going to go up significantly. So on a long time horizon, those 250 cash flows are going to grow exponentially, because rate, I don't know what you guys think, but rents typically, I don't know what the number is, I would say they go up with or exceeding the values of home values, right? So at the end of the time horizon, you should be making over $50,000. So if you go to the next slide, there we go. Oh, thank you. The assumption was that you bought these houses, these 5 properties, the $200,000 ARV. By the time that you get to the 10 years, they're going to be $325. You're going to owe $650. Your refi, the balance you have on the refi is going to be $265. We assumed a 6% interest rate on the rental property loans. on a 30-year mortgage. And if you skip down to that very bottom number, by the time you're done, just 10 years down the road, you take that cash and you deploy it and buy 5 properties. Your overall net worth, if you couple the fact that your property is worth a lot more, what you owe, and then your cash flows, you will have gained over $1 million in net worth just by buying 5 properties and holding on to them for 10 years. So, in the original scenario, like I said, 570 sounds great, and it is. But if you just take take that property, have the foresight to deploy that cash and buy more properties, at the end of the day, 10 years down the road, you'll be over $1 million richer because you made that decision. So that's what we've been trying to talk to a lot of folks about. Because rates are a little bit higher, that maybe they refinance and they got a great rate and they can't see the fact that if they were to, like I said, use that money, get rid of that rate, buy more properties, in the long run, it's really a no-brainer how much better off they're going to be rather than doing nothing. I don't know, Jeff, if you ever have to have these conversations with folks, this is a summary here, but it basically just kind of outlines the exact same stuff I was talking about.
So on your chart here, where it says ARV of your new buy property, is that also your purchase price?
No, that's the ARV.
So where's your purchase price?
We didn't build in a purchase price. We just built in an out of pocket. So
okay, all right.
Yeah, built in out of pocket.
So your initial equity capture position isn't represented here, right?
Well, no, your initial number is not represented over. It does go into the calculations, but if you were to say buy 5 properties, you kick in your 30 grand, you're sitting at $50,000 equity per property because you have a 200,000. What's the ARV? 200. You have a $200,000 ARV and you owe 150. So each property you have a $50,000 equity position.
So you capture 20. You capture 20 on each one of these.
Yes.
And that's it. Okay. All right.
Yes. Correct.
All right. That's a little bit conservative compared to what we're doing, but consistent, right?
Conservative, meaning you guys are getting a little bit better deals.
We're getting a little bit better than that, right? You have 30,000 out of pocket. Lately, we've been getting 25. Your 20 grand equity capture. Lately, we've been at closer to 30. So yeah, I think that if somebody does this, there's a good shot they do better than what you represented here. So as good as that was, $1 million on 5 properties, I think you can do a little better.
And I also think for most people, even though they might have a 10-year or 5-year horizon to either refi or to do cash out, whenever we put these numbers on 30 years, which would be the worst case scenario if you did not choose to take cash out to do more deals, right?
Mm-hmm.
And in either scenario, these numbers grow just exponentially. The variance, I mean, on the typical deal like this, it's probably a difference of like 6 million over a 30-year time horizon or more. So it's just not even really comparable. So it's just a powerful demonstration of how the interest rate on your primary mortgage is one minor factor in your overall financial situation, and to really have a broad view there.
Think about your daughter, right? She can look at a 30-year time horizon, and that number is going to be outrageous for her.
Look, I started at 27 years old, right? And I've seen, I'm 22 years in, so I've seen almost that 30-year horizon.
Okay.
Been great for my family for sure.
No doubt. Well, we did have a few questions today, but honestly, we are up against it, and I want to respect Jeff and everybody's time. We're going to try and answer those questions for people individually. I know David has been working on that, and he's going to present some of your questions to the management team, and we will definitely circle back around with you. But Jeff, it's been really enjoyed having you here. Do you have any other last minute thoughts or advice to any of the people on the phone that are real estate investors?
Yeah, I think that if you're a real estate investor, I mean, the whole premise behind Lifestyles Unlimited is find somebody who's doing what you want to do well and copy them. And I think that all of our realty team at Lifestyles Realty, we're all investors. We're all doing this. Some of our new guys are aspiring investors, right? But like you guys know Jennifer McCormick, right?
Sure.
She's, we have 4 of the top 25 agents in the whole city in Houston out of 45,000 agents. Jennifer started with us and was not an investor yet. And, she's been in the top 10 of real estate agents in the city for 5 straight years. I mean, you want to get around people like that who, whether they're, who just have a drive for this, and find people who are doing it. You go to Lifestyles Unlimited, get a mentor, and let them get you hooked up with us at Lifestyles Realty, because we can really accelerate your investing future.
Oh, you're so close to saying our tagline. I was like, oh, is he going to say it?
That would have been a nice thing to say. Accelerate your future in real estate. I also want to say with Jeff and his team, Jennifer McCormick, Moon Kim, all these top ranked people there. It's just really an incredible team, and we've seen them take people that may think they don't have enough money to really get into real estate investing. And then the next thing you know, they've got 4 or 5 cash flowing properties that are just total game changers for them and their financial future, really to build generational wealth. So it's an exciting thing to see. So definitely reach out to their group. Just a great team that can, to Jeff's point, proven winners throughout it that have succeeded in what most of the people on this call want to do. And that's the best way to do it, is get around people who have succeeded, right? No doubt about it.
Absolutely.
Okay, everybody, we really appreciate your time. Happy investing, and we'll talk to you soon. Thanks, Jeff.
Thanks, Jeff.